So is paying points on a mortgage something smart to do, or is it something you should avoid to save yourself money over time? We're going to look at a live example, someone who actually called in, wanted to run through some numbers that they were looking at to see if they're getting a good rate. Because out there right now, a lot of mortgage people keep saying, hey, we're not charging you any points. But guess what? They're still making money. And how are they making money? They make money by raising your interest rate. So instead of getting a 6% rate, you're getting 6.5 or 6.75, depending on what they want to make as far as what they consider their points, their income. So now remember, a point, when we talk about a point in the mortgage industry, what that is 1% of the loan. The typical mortgage companies out there you're going to find are earning somewhere between 1.5 and 2.5 points or percent on a loan when they close. So that's how the mortgage industry works. If they're not going to charge you points, if they're not going to put it on your settlement statement, they're going to still make their money, but they make their money by raising that interest rate, like I said before. We're going to look at a difference of an interest rate of 5.75 with paying a point to actually paying a little bit more than a point, or 6.5 with no points, meaning no money out of your pocket. What's better now? What's better long-term, and what does it mean to you with a real live example? So let's take this example, the $300,000 loan, the options out there for 5.75 or 6.5. The easiest way for anybody to do this, and we're going to go through this on our screen, is we're going to use something online that anybody could use, calculator.net. So we're going to run into calculator.net, and we're going to go down to where it says amortized calculator, because we're going to use some of the functions there as we go through this. So amortized calculator, calculator.net, and we're going to change the dollar amounts that they have already in the system. In this case, they were looking at a $300,000 loan over 30 years. That's what your typical mortgage is 30 years. And the no point was 6.5. The beauty of this is while you are out there shopping, you could put your own information. At this point in time, 6.5 is the rate that was quoted to them, but you may be out there and now rates are lower, higher, whatever. This is how you determine if the two choices, which one's better. Because it's not always one or the other. Each scenario is different. I'm just going to show you how to do it. So in this case, we have the 300,000, 6.5. So let's open another window, go into calculator.net, and we're going to go into amortized calculator. We're going to put in 304. So a little bit more than 1% or a point, but we also know that if it works at 304, it's going to work at 303, just in case you run up against some higher pricing when you're out there looking. Once again, this whole function and how you look it up, just looking at two different calculators, you could use for real life information you're getting from your mortgage person. And now we're going to look, we have, in this case, a payment of $1,774.06. And if you're going to take the interest rate, the 6.5 on the 300,000, not pay the point, have them paid outside of closing, you're going to see a payment of $1,896.20. So first glance, for some people, that's not a big difference. It's only $122 and some cents. If you looked at the cost of $4,000, and typically what people would do is take the $4,000, they would divide the $122.14, and they'd find out it takes almost 3 years to break even, meaning the amount you save compared to what you're going to pay, it takes 3 or 4 years. If you're not going to stay in your mortgage that long, this looks like an easy choice. You're going to take probably the 6.5 because your break even point is around that 3 years, just a little bit under. But here's the real magic. If someone was going to take these two examples and they choose to pick the 7.5 because it's just not that big a deal, you want to work with the people, it's not going to make that big a difference in your life. Let's go over one thing that I was telling her as I was running through these numbers. The 122, if you put that back into your life, could be going out once a month because you're saving that every month. It could be you taking a vacation every year, maybe a local vacation, but still a vacation. But let's look at it another way. If you're comfortable paying the $1,896 and the higher rate, how about we pay that same amount with a lower rate, which means we're going to pay extra every month. We're not going to pay the $1,774. We're going to add that $122.14 to the lower payment. What we find out here is with the lower interest rate, adding that extra payments, we get out of our mortgage in about 4.5 years sooner. So now this is where the big magic trick happens when you're talking about compound interest, and we're talking to our customer today. Is like when you look at this, if you're going to go with the 6.5 because it's just not that big a difference, you don't want to add that $4,000 to your loan or pay it out of pocket. And in this case, you added the 122.14 to it, what does that look like? Well, it looks like you've just saved 4.5 years from your mortgage. What does that mean to your pocketbook? That means you have 54 payments you don't have to make on this loan, which is the lower interest rate. So in this case, when we run the numbers, someone looking at long-term, getting out of debt, not working forever, it's a lot better when we put all the numbers in and add the payments so they equal out. In this case, we're going to save 4.5 years. 4.5 years times $1,896. Now we're looking at saving over $102,000. Now the difference, when we talked about this from the beginning, is what's better. In this case, where we're having these two examples, it's better for them long-term to actually take the lower rate, pay the points, and put that savings into the payment, because they're going to save over $102,000 over the life of that loan and pay it off earlier. When people are looking at when can they retire, just cut back a little bit. Paying things off earlier is a lot better strategy than just giving the banks that extra money. But for all those people out there saying, well, I'm not going to keep it 30 years, I'm going to get out of it, that's good too, because even after 2 years, going with the lower interest rate is better. It's not better by a lot, it's better by about $200. After 5 years, it starts accelerating. And now it's better to take the lower interest rate by a little over $7,300. And after 10 years, it's $21,000. So if you're going to stay in your property, looking at this example, it is better that you pay the point, take the lower interest rate, apply that money to the payments, and get out of debt faster. And get out of faster doesn't mean if it's 2 years, 5 years, 10 years, you're still accelerating that debt that you owe. Here's what to take from this video. While you're out there shopping, is it better to pay a point, not a point, whatever it is, a percent of the loan? Ask the mortgage person when you're shopping, what is the rate that they will give you if you pay them a point? And then shop around. Take those numbers, put them into something like calculator.net, see where you line up. By using this strategy, you're going to eliminate some of the excess debt that you're paying. Like I said, in this case, she could have paid an extra $102,000. That's an extra $102,000. That's not even all the interest that she was going to pay. On a $300,000 loan, paying an extra $100,000 over your life, that's where these little mistakes add up, and you just don't have the retirement that you really want or you're looking for. So check below. We'll put a link to the calculator if you want to use it. It's just an online calculator. It's not our calculator. If you have any questions, just leave them below the comments. We'll get back to you. And also help others by subscribing or sharing this video. Remember, we're here for is to pump more money into your life. Make sure the banks get paid but not overpaid. Enjoy more life and use debt. Don't let debt use you.